Hello everyone, welcome to our fourth guest speaker. I have a guest speaker series every year, and you're number 4 this March already. In March I had 4. You understand?
Right.
Yeah, no, very busy, okay? Very exciting what you're going to do. Professor Tata, as you probably know from my email, is a professor of corporate finance in Berlin. Okay? And he was here last year, and because he was very popular, and he always talks about new things. I always talk about the same thing, but he talks about new things. He comes up with new things. Last year he talked about real options and about blockchain and so on. Today he talks about something similar, okay, tokenization of bankable assets. So I hope it's of interest. You're going to speak for 30, 40 minutes, and you can ask questions in between.
Yes, absolutely.
Over to you. Professor Tata was previously a derivatives trader, structurer, a little bit like me, at JP Morgan. I was at Citibank and then DLJ, so we have a few things in common. He's got a PhD from Harvard in St. Gallen, and a few other things that he's going to tell you about. So thank you so much.
Okay,
Over to
thank you. Thank you for the opportunity. Okay, folks, thank you very much for showing up to this short and hopefully enlightening lecture. Don't worry, it's not going to be technical or cumbersome, so hopefully it's something enjoyable. So the topic I picked today is something that is new in the financial market, and the financial market is actually quite an interesting market because there's always innovation, there's new technology, and one of the technologies being used, you're well aware, is the blockchain technology. And with the blockchain technology, you are able to capture things from the real world and represent them on the blockchain. And that's what we call tokenization. We basically take something in the real world, could be a horse, could be a carpet, represent it on the blockchain, and then it's basically a token on the blockchain, and you can trade the token, sell the token, do things with the token. So this is a kind of the idea of tokenization. And for today, I'm going to focus on one particular type of asset or value, piece of value you can tokenize and use on the blockchain, and that will be music. So you see there's like a wide range of things coming together. We have the artistic stuff from the music world, we have the finance world, the banking world, and we have the technology, all these things coming together. Now, sometimes you have these kind of overlap. So one of the overlaps I could think of is Mick Jagger from the Rolling Stones, because obviously he was first in the financial world at London Business School, or LSE, at LSE studying accounting, and then he switched into the music world. Thank God, because I think we don't need one more accountant. It's better to have one more Rolling Stone. So sometimes things come together, and here that's what I'm trying to show to you today, that again we have this kind of connection between music and art and the finance world. Some people think it's somewhat boring, but it's not actually. So just a few words about myself. I'm German, as you can tell from my German accent. I grew up in Berlin. I started with JP Morgan, and one of the first things I did is in New York I was trading derivatives and selling derivatives, so I'm kind of a derivative guy. My mindset's always thinking about options and stuff like that. And then I came back to Berlin to become a professor. I'm still trying to connect the financial world and the academia to make it exciting. And by the way, just a little bit of advertisement. That's the only advertisement I'm going to do. If you ever plan on starting your career in investment banking, so sales, trading, research, derivatives, that kind of stuff, I want to point out that I published a book just for people like you who are not quite sure which area do you fit in the best. Am I more of a trader? Am I more of a salesperson? How is life on the trading floor? What kind of language do they use? What do they expect from me? That's all in that book, Corporate and Investment Banking. You probably find it in the library. It helps you to also prepare for interviews. So that's the only stuff I want to tell about myself. So let's dig in to what we are trying to do today, and that's talking about the tokenization of non-bankable assets. So first there's this question, how does tokenization gonna help to make a market more efficient, to add new assets to the mix of asset classes, and that's what we're trying to look at today. And of course, there's great hope that this kind of new technology makes the financial market much more complete and more efficient. We have more digitalization, we have more automation, we have efficiency gains, cost reduction, stuff like that. So all these kind of goals we have in other areas also, but also in the financial market, will play a role in what we're going to look at today. So the agenda is, just because we only have 45 minutes, a kind of a light agenda. First, we're just going to look at the assets under management and how much of a fraction that is of the global wealth. Because of course, in this course, you're going to focus on assets under management. You want to help other people potentially to asset their management and their assets, and therefore you're going to become a manager, and we'll see that assets under management is only a very small fraction of all the wealth we have on this planet. Then once we click that off, then we're going to look at the tokenization of real-world assets, how we do that, taking assets from the real world and tokenize them, put them on the blockchain. And then we look at a short case study, how we're going to use music or streaming-based revenues from streaming music, and tokenize that, put it on the blockchain, and find investors and have the musician benefit from that whole process also. That's the kind of idea. All right, so let's look at the wealth, the wealth on this planet. And just to warn you, you get tremendously different figures. Everyone who's doing a study comes up with different figures. So take that with a grain of salt. Whatever figures you see, it's more the direction that's more important than the absolute figures. So here I grabbed some figures from the World Bank. It's already a few years old, so it might not be the latest one. And they estimated that the global assets on this planet, which includes everything, not just stocks and bonds and property, but also carpets and racehorses and antique cars, everything, all the assets we have, 1.3 quadrillion. Quite a huge number, huge. But just look at the large size in comparison to how much assets are under management. And at the time, the estimate is probably more by now, it's only to be 100 trillion. Well, 100 trillion is still a lot, but it's so much smaller than the whole pot. So now imagine you're a wealth manager. You're working for, I don't know, HSBC or JP Morgan, and your job is to generate more income for the firm. There are basically two choices you have. A, you compete in this pot, it's a big pot, you compete with the other wealth manager and try to get some clients, switch from the former banking relationship to you. Steal them away from your competitor. Very difficult, because some of them are very happy with the bank they're covered by, some of them get better terms you can offer. So, in that sense, stealing away business from other banks, very, very expensive, very expensive. Or you can tap into this wide area and look for assets that are currently not being managed right now, and add that to the mix of what you offer your clients. I'm managing it for you. So some guy comes with a racehorse, you could say, give me the racehorse, I take care of the racehorse. Kind of difficult, right? Where do you put it? You have to feed it. That's probably not a good idea. But a good idea, and that's what we're going to talk about today, is maybe take some of these real-world assets, have them represented somewhere, for example on the blockchain, and then help the client to manage the represented asset on the blockchain. And therefore, you can expand the universe of assets you're helping to manage, and that gives you a foot into the business. Right? So that's the kind of first graph we're looking at. A second graph, and that's by a different, unfortunately you cannot see the bottom, you're going to get a copy of the presentation when you see the sources. Different source, okay, so this is a different source now, and the numbers are slightly different. And here on the left-hand side you see the real-world assets, so the big over time, and what's made up or. On the right-hand side you see the tokenized asset market. But be careful, it's a very different scaling. This is 1,600 trillion, this is 10 trillion. So first of all, the real-world asset market, like the big market, you have stocks and bonds and real estate and whatnot, all that. And it's growing, so this is good news. You're actually taking a nice class here because you're learning about something that's growing, like many other businesses are kind of stagnating. But the wealth on this planet is going up and up. The rich get richer, so to speak. We're constantly discovering new wealth, sources of wealth. So it's growing, so that's the good news. But when you look at here, the tokenized asset market is very small in comparison. Right? It's a fraction, just 1% of that. But look at the growth, the expected growth, exponential. And whenever you see something that has exponential growth, bet on that. Because eventually, exponential growth is going to beat everything. Right? It starts small with one bacteria in your body, and then after a week you're sick, and 2 weeks later you're dead. Why? Because these bacteria are growing exponentially. Exponential growth means that it's just a question of time until this market is becoming big enough to compete with this market. And that's why in the financial market everyone's looking at this. Tokenization, it's still small, but you want to be in the game early enough to benefit from that tremendous growth that's going to come up. All right? So this is just a little bit to give you an idea about the market, how attractive the market's going to be, because once you hit the market to get a job, this will be so big that there are departments and hundreds of people being hired. So you want to be in this space. All right, so let's now look at a little bit more about the tokenization of real world assets. I know there's a lot of text here. You can read it later. The important thing is that in the real world, there are many assets that are so far not being managed properly. You know, here are some examples being vintage cars, watches, you know, stuff like that, but also music rights. So all that is not being attractive from a financial point of view because it's illiquid, it's hard to trade, it's hard to separate it into smaller pieces. A racehorse is a racehorse. You cannot buy half a racehorse. Where you cut a racehorse, you have two half but dead racehorses. So that doesn't work. So there are a lot of reasons why these non-bankable assets, as they are being called, are non-bankable because the bank can really deal with them. And now through the concept of tokenization, where you represent something on the blockchain, then of course this representation you can, for example, divide in smaller pieces. You can buy the right to half a racehorse, and if that's still too expensive, you buy tens or millions of a racehorse. Same with Picasso. You could buy a small fraction of a Picasso because once it's on the blockchain, you can divide this unit into smaller pieces, and it becomes more liquid. It can be traded like anything on the blockchain, like Bitcoin, and so on. So suddenly you open up this market to completely new investor classes, investors who have very little money to invest, but still want to have the benefit of diversification. And all that is suddenly gaining momentum. And here's another number I'm quoting from yet another study, that in the year 2026, there's supposed to be currently 33 billion of the real world assets represented on-chain. So on-chain means that they're somewhere on the blockchain represented through a token. Now again, 33 billion, very little, but the study found out 2 years earlier, so basically 2024, was only 8 billion. So going from 8 billion to 33 billion in just 2 years, and that gives you an idea of what's going to happen 2 years or 4 years or 6 years from now. It could be a significant market. Now, this whole tokenization, the idea of tokenization, you probably think, oh yeah, there are like a bunch of people who are doing it and that's it. No, this is a whole ecosystem. This is a whole ecosystem similar as wealth management is an ecosystem, or trading of stocks is an ecosystem, which means that not just one participant, there's a variety of different type of firms who play a different role. And why is this important to you? Because if you like this whole concept, you still may not like one particular part. Say, I don't want to work for an investment bank, or I don't want to be a programmer. But the ecosystem is so big that there are many different roles involved. So just let's look at some of them. Who would be involved once we have assets tokenized? Of course, the asset managers. That's a no-brainer, of course. They are, and they're already very active going into the space. The big one, BlackRock, JP Morgan, although Invesco. But that's not enough. It's not enough if an investment bank says, yes, I'm willing to manage your racehorse. Once it's tokenized, there's a lot more that needs to be done. You need the blockchain itself, where you can put it on, right? So Ethereum blockchain or Solana, the company is managing the blockchain. Then you have the companies helping to issue these new tokens, because the bankers, of course, cannot do that. They're bankers, they're not technology savvy. So there are a lot of companies just specializing on issuing those. Then, of course, once you have tokenized something on the blockchain, you don't want to hold half the racehorse for the rest of your life. You want to trade it, buy another one, sell it. So trading venues are getting involved. Some of Binance, for example, they're already trading other crypto assets. So for them it's pretty easy. Once they can trade Bitcoin, they can also trade the token on the racehorse, no problem. You have custody and wallet infrastructure. Where do you put the token? Once you bought it, you need settlement and payment. So you see there's like a huge ecosystem, and all these people need to hire people soon who are savvy enough to understand what's going on. So this is going to be a huge job market, a very potential job market for all of you to tap into. And depending on where you position yourself, you're more on the investor side, you understand the investor, you're more the diversification kind of guy, you would be here, or you're more the tech guy, interested in blockchain technology, maybe you're here or here. So you can position yourself depending on where your preferences are. To give you an idea how you can basically take that concept of tokenization or new asset, non-bankable asset, and fit it into kind of the classical way how investment decisions are being monitored by academics. And I don't know what kind of classes you had before, but soon enough you're going to have a class about capital asset pricing model, the CAPM, capital asset pricing model. And here basically the idea is how do I estimate kind of a fair compensation for any kind of investment. And the capital asset pricing model, when you look at the textbook, typically they talk about stocks, right? Because that's kind of an easy thing. It's an IBM stock, and then there's a Google stock, and you have one of each, and you have diversification, stuff like that. So this is kind of the framework, and it's very important to always link a new thing to an old framework, because it's also a way to open the door as a mean of discussion, because you don't want to walk into a room and come up with a crazy idea. You want to kind of link it to what people already know, the framework they're using, and then convince them that even with their old framework, it makes sense to do what you're proposing, right? So sometimes theory is a marketing tool. If I had more time, I could spend about how to use theory as a competitive edge in your career, but we don't have time for that, but you can believe me that it makes sense to have some of these theories as tools in your brain, because you're going to use them. So sooner or later you're going to talk to an investor, and an investor is going to challenge you and tell you, yeah, there are risky investment, which is what's called a high beta. They move a lot when the market is moving. There are investments with a low beta, they hardly move at all, and there's some sort of connection between the riskiness, the movement in the market, and the expected return, which is represented in the CAPM framework with the security market line. And if you're on the security market line, it's kind of a fair compensation, more risk, more return, less risk, less return. And of course, when you look for a new investment and you're talking about something new, no, this is not stocks, this is not bonds, we're talking about music. Where's the music on here, right? Where's the music? Where do I find the music? You say music is here, high risk, no return. They say, okay, thanks for the idea, goodbye. So you need to show that you are above the security market line. It's a new asset class, and well, you get a higher compensation compared to using the old assets. I have to just look at the watch for a moment, and I don't go over time now, because I'm talking fast, right? So here I did a little study myself, right? This is from my own publication, where I took art as an asset class. It's already considered an asset class, art, and represented by an index that measures the return and the transaction in the art world, so-called art price 100 index. And what you find is, when you do the analysis, you compare the riskiness. The riskiness is defined as how much does it move if the market is moving, so some sort of correlation assumption you have to make. And the expected return, how much do the art prices go up, auction by auction. And you find the good news is that art is a dot above the security market line. This is a very wonderful kind of opening of a discussion when you talk to an investor, or you talk to a hedge fund. You're proposing something that has a higher return than other combinations of the existing assets, right? And this is a kind of framework you could use, for example, even when we talk about music or art or racehorses. So you may get the question, where's the racehorse? I don't see the racehorse here. It better be attractive using the existing frameworks, because otherwise people will be very skeptical and say, well, that's a framework we're using. So, right? But you have to understand that some of these new technologies also allow investment that have yet another dimension beyond the CAPM. The CAPM is great, people got a Nobel Prize, but you young folks, you move into a future where people may evaluate investments for other dimensions. They may say, I want to be economic, yes, but I also want to be environmentally friendly, I want to be socially responsible, I want to foster local growth. So there might be other dimensions you don't find in here, So even if the music is slightly below the line, you could argue, well, it has some other advantages, right? It's always cool, you know, on the party, you know, where did you invest your money? Oh, I bought IBM stock. And you can say, I own a fraction of the music catalog of the Rolling Stones. That's a much better icebreaker at a party. So a lot of people make investment not just because, you know, their risk-return profile is perfect, but also because, you know, they feel good about it. When people buy Google and stuff like that, that's a cool investment. Who wants, buy a stock from a company producing dog food or something like that? So anyway, so just to let you know, but it's always good to also force yourself to think about how does it fit into the existing frameworks. And I challenge you here at the university level, when you go to lecture and they talk about all these theories, CAPM and whatnot, you know, challenge the professor and ask the professor, okay, that's all nice, the textbook's like 30 years old. What about the new asset classes? What about the music? What about the racehorse? You know, some will go, I don't know. But that's a valid question because some of these models need to be, modified going forward. Anyway, but even like with the current old models, you find that some of these block-based investments are actually quite attractive. And that's why now so many professional investors diversify away from the classic, asset classes into the more creative one because it seems to make sense. Right? So now let's look at one particular example of tokenization, how it can be used, and that's music. Right? Music is nice because everyone has an emotional, connection to music. Not necessarily everyone has an emotional connection to an IBM stock. Right? Some weird people, yes. Some finance people, yes. But most people know. But music is something emotional. We know, we know. When we hear music, we know I like it or I don't like it. And that's also very important because that's one of the criticisms about finance. It's so mathematical. What if I don't like mathematics? I want to go by my heart. I want to go by my feeling. Yeah, once you tokenize things, you can tokenize things you have a feeling about. Food you like, music you like, and you can invest with your heart. And I know they teach you something different here at the university level. Leave out your heart, use your brain, do the math, do the calculation. But some successful investors actually did something opposite. They just did what they felt was right. They invest with their heart, and sometimes you can be successful with that also. So here music is one way you can do it. So music, first of all, is music attractive, right? When you want to pitch something and it's a small niche market like racehorses, probably a bad idea. There are not that many racehorses. But music, is that a market people could see as big enough that it really makes sense to set up the infrastructure to tokenize and trade those kind of things? So let's look at the music market. It's pretty big actually, and it's expanding. People estimate it to be around 14 or more billion by 2030. It's growing. The growth is always more important than the number. Personally, I think 14 billion doesn't sound that big. If you come from the fixed income world, it's a kind of peanuts. But anyway, it's growing, so it becomes more relevant. And it is a very predictable market because the streaming of music is kind of an ongoing business. People listen to music, to Spotify every day, every billion people or more. So it constantly generates some income. It's not a cyclical market like many other markets, real estate market. No, it's kind of people do that. So it's a predictable revenue stream, which makes it very, very stable. And remember, we are thinking, this kind of framework, risky, less risky. If something's very stable, then it's more on the left side. That's always a good thing. Right? You have other things like NFTs, like monkey faces trading on the blockchain. That's not very stable, right? That could be extremely profitable if you buy at the right point in time, but it could also have tremendous loss. But music is actually quite conservative. If you talk to people in the music industry, they'll tell you it's almost boring. It's almost like bonds, where you get 7%, and the next year you get 7%, and the year after you get 7%, and then 1 year after you get your money back. How boring is that? Yeah, but they tell you music is kind of the same thing. Because, Taylor Swift, she's like selling songs like, do you think that goes away next year? Same thing. And by the way, people put it on the you know, when they hear Spotify, they put it on the playlist. Once a song is in the playlist, people don't even choose a song, you know, they choose a playlist, and then it comes again and again. It generates income. It's almost impossible not to generate income. The only risk is that there's some sort of shitstorm, because as an artist you do something stupid and people, you know, avoid you for political reasons or something like that. That could happen, but if you don't make that kind of mistake, you're golden. The music's just generating, like books, just generating income. So it's a very attractive market from financial point of view. And also, the music industry is actually a very modern industry. It has a lot of digital innovation, right? We already see the distribution had changed a lot to streaming, Spotify, that kind of stuff. We have like billions of audio streams globally. You know, now they're even moving ahead and they even monetize beyond streaming, and they're using AI to basically understand the way you consume music and then pitch you other products and advertisements, stuff like that. Right? So it's a lot of innovation in this space. They are, you know, very technology savvy people. So it's an attractive market. It's a very attractive market to look at. Now, what you can do, like, as I said, to me, music is something very emotional, right? It's like falling in love. There's no thinking about it. You hear a song, you love it or not. So that is a market that's similar to love, right? Can you buy love? No, you cannot buy love. But the music market itself is a very predictable stream. So what you can do is you can take advantage of the cash flow the music is generating. That you can do. And so therefore, it's very attractive for a number of participants. Now, whenever you suggest something to be traded, like a product, a future contract or a stock or what, you always have to make sure there's two-way flow. It's not just one person making a lot of money and everyone else is losing. Everyone involved needs to have a chance to benefit from it, because only then you have an ecosystem where you have people generating it, buying it, selling it, trading it. Everyone needs to have a benefit. So let's look at the music market. Why is it beneficial? So from an investor point of view, I already mentioned that if you plot it on some CAP-M model type of theory, then it doesn't look bad. So investors are kind of cold-blooded. They just say, as long as they give me a good return, I'll do it. And by the way, it was kind of interesting. I went to a presentation of a token-based music catalog. We'll talk about that later. And they talked about, yeah, how it works, you know, the music rights, and ooh, it flows like this, and the money, and then it pays like a high interest rate. And one of the investors were actually asking, yeah, what kind of music is it? Like hoping that you get an answer like, oh, it's Michael Jackson and Rolling Stones, something like that. Oh, I love it. And that's kind of the totally wrong question to ask. So the guy said, well, you know, we don't try to pick winners. We don't try to pick music that sounds good. We look at it analytically. What is the cash flow? You know, how old is the artist? How long? How many records out? You know, stuff like that. And then we buy a catalog of music which kind of balance itself out. So there's, you know, there's some like German Humpa music here in the beer set, and you would say, I never want to listen to this kind of music, but it's part of the catalog, and you benefit from the catalog. So it has a different point of view. The investor doesn't really care about, do I like this song that's in the catalog? No, it's more important that the catalog has like a very stable cash flow stream. And you can do that with music because there are, you know, so many people with so many different tastes, and you can create, and they're using like quite sophisticated, I wouldn't necessarily say AI, but you know, techniques to generate a catalog that has most stability and lowest risk. And you find any kind of music in there. Any kind of music. There's some people who are just writing music for films, and some people soul music and rap music, and everything is in there, right? But investors can basically take that, and it's kind of similar to the approach, which stock should I buy? Like not the one that sounds cool, but that's a good benefit to the existing portfolio. It has like the lowest correlation with existing stocks and blah, 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 and stuff like that. And you can do that with music also. So investors are actually like that kind of approach, and they are able to find ways to generate cash flow streams that are very attractive. Artists also benefit from it. Why? Because for an artist, a lot of costs are front-loaded. Like if you start a band, you need to buy the instrument, you need to buy a car, you need to go on tour. Like the first year or two, you get very little revenues from your music, but you need the money. So you need the money first and then you generate income later. So typically, when you have this kind of situation, like IBM needs the money first to build the factory, gets the revenue later, what does IBM do? Go to the bank, get the money, no problem, or sells a bond. But musician cannot do that. Musician going to a bank, of course, they will be turned down. No one wants to give money to a musician. Well, you know, I believe in my music, you know, I hope. No, you don't get money. So banks are not providing cash flow to the artists. The studios do it. Yeah, you sign a contract, but then you sign off all your rights for the next 3 records, so you basically make a pact with the devil. But the studios are also very picky, right? Yeah, they accept Taylor Swift, but will they accept you as a small musician? So the studio, the bank, and then the financial market. Have you ever heard that the artists issue a bond? Like I think David Bowie did it. Like you have to be really big to do so. So you don't find anyone supporting your financial needs, your cash flow needs, which is front-loaded. And this is a way to, you know, monetize your future income by tokenizing the revenue streams attached to your music catalog and sell it in the market and benefit from it now, getting the cash flow now so you can spend it on your career. And the whole music industry in total also benefits from it because it allows a much more healthy music system where people with little money still survive, because a lot of great songs have never been recorded because the artist didn't receive enough money to do so. This is the sad thing. There's so many good songs, but there would be so many more good songs we never hear about. Why? Because no one was able to afford to produce music. And with this kind of framework, even society will benefit because we make it easier for artists to produce what they're good at, right? So now a little bit more technical. How do we kind of create a cash flow that makes it attractive from investor perspective? It always starts with the music users who use the music and hopefully pay for the music. And one way or another, for example, with your subscription to a streaming platform, and then the music users basically pay, you know, and this money then goes into some sort of distribution pot, you know, basically royalties that get distributed, you know, everyone has a different concept, you know, how many clicks or music on Spotify, or how many, you know, records being sold. We don't have to go into the details, and there are like distribution companies, like GEMA, involved. And they basically distribute then the money that's being collected to the rights holder. And the right holder are the artists who publish it. Now with art, there's something very specific. You cannot actually sell the right to art. You always, as an artist, you always own the right. So that's very different from other type of cash flows where you could basically assign it to someone else. You write a song and then you give it to someone else, and the other one is now has a copyright, the ownership. That doesn't work with art. And that makes it a little bit more complicated because in the end, it's the artist who receives those rights, but the money you get is you get the money later, next year, 2 years, 5 years later, once the song is being played often enough. So what the right holder then does, it assigns those cash flows to another entity that's been created, a special purpose vehicle, for example, some, you know, basically company only put into life for this particular purpose. And this SPV collects the money that's being paid to the author. So the author basically makes a contract, you know, say whatever I receive from Spotify, I pass on to you, right? And now this special purpose vehicle, you know, can start issuing instruments in the market, bonds, for example, and pay, you know, people who buy the special purpose vehicle. So someone, bondholder, would buy it, pay 100. This 100 can be used to pay the author of a book, or the publisher, or the label, or the musician, right? And then they pay the cash flow they receive into the special purpose vehicle, which is then being used to pay a coupon, an interest payment, because the bondholder does not at the end want the money back, they also want to earn something. And then at the end, of course, the musician needs to pay back the SPV. Hopefully by that time the artist has collected enough money so that then there's no problem to pay it back. So it's, instead of going to a bank at this juncture and asking a bank, can you provide me with a loan? Here you have the assets that generate the wealth to the artist or generate the cash flow being used to back this instrument that then can be put in the financial market. this is kind of the idea of the cash flow. And when you look at it, you say, well, here, for example, 7.5%, this is a lot. Why does a musician have to pay 7.5%? Most musicians would love to pay 7.5%. They go into the bank, they're being turned down even before the percentage comes up. They would love to pay 10% or whatnot. They just don't get money. So here's a solution, at least it's a feasible solution. But of course, as an artist, you have to pay a high interest rate. You are not, you know, IBM, because it could happen that your songs are not successful, so you have to pay a risk premium. So now let's look at two particular bonds that actually traded. And they're not only they traded, they're also being put on the blockchain. So it's a blockchain-based structure. You could also do it without a blockchain, but I find blockchain particularly attractive because why? On the blockchain, once things are tokenized, right? Typically you tokenize a catalog, but let's say Taylor Swift says there's one song, I want to kind of give my fans a chance to invest in it. This one single song gets tokenized, then not by one token, you will probably create like 1 million tokens, so when you buy one token, you only own millions of that song. It's very emotional. You like a song, maybe you hear it at the concert, it's really great, and you say, you know, I wish I had some also financial connection to that song. Yeah, I cannot approach Taylor Swift, ask her whether she, you know, assigns me the rights to the song, probably not going to do that. But if I can buy millions or 10,000 of that song, and then every year I receive a little bit, cash flow, depending on how many people listen to the song, that would be cool, right? Because it's really investment by your heart, and maybe it even pays out for you. And even if it doesn't pay out, you know, you did what you thought was the right thing to do, so you're probably not going to cry as much as if you buy some financial investment you don't have any connection to and you just lose money. So here are two kind of these bonds, and these bonds, they put out, there's a company called 12 by 12. You can Google it. There are two ways to spell it, 12x12 or in one word. And what they did is they basically put out two bonds. One's an institutional bond where they created something just for institutional investors. So then they approach like the big investment firm. And they did a second bond, a retail bond, which allows you and me to also participate in it. Right? And that was 2023 and 2025. Here, when they issued the institutional bond, they used chartered investments or big investment firm to help them. And here, for the retail bond, it's already purely blockchain based, so they didn't even need the investment bank. So that's the nice thing about the blockchain. You can always ask, is the investment banking infrastructure really something I should pay so much fees for? Like these investment bankers that charge a lot of fees? Or is there a technology solution that, you know, almost creates the same outcome and I have to pay much less? So here for the retail bonds, they decided not to go with the investment bank, they did it on the blockchain, right? Or you have an ISIN here also for the retail bonds, so you can look it up if you want to on, I don't know, Yahoo Finance or something like that, you'll find it. So how is the structure of the bond? Now the institutional bond, because it's basically created for a few institutions by invitation only, we have very little information about it. Some information we don't have, we don't even know what the coupon rate is. We don't know how much the compensation is. Now the thing about the retail bond, there we know it's 7.5%, and the term is 5 years. So you buy a bond for 5 years, you get your money back, meantime 7.5%. Small volume at the juncture, only 30 million, because they're only small catalog they use, and the denomination 1,000 euros. So even you, with 1,000 euro, you could get involved. That's a minimum investment. Here on the institutional side, of course, it's much larger. It's 100,000 minimum. So then what is the underlying asset? It's kind of similar, right? The asset base is always the money we saw in the cash flow coming from the distribution to the artist, because the distribution always goes to the artist first. So these could be royalties paid out by GEMA, or any kind of contracts the artist already has. Maybe the artist already signed a contract with the studio, so the money goes to the studio, and the studio just makes a payment to the artist. And that's the asset base. So the artist basically promises to take those, you know, cash flows and hand it over to whatever structure you're creating. So here, you know, in the institutional, 3,000 different songs, you know, and here receivables from also a large catalog. underlying catalog, 10 billion streams, more than 720 top 10 chart placements, but a different music styles. So there could be like country music, rap music, all kind of music. And top 10 doesn't mean top 10 now, it was at some point top 10. That's enough, because once something is top 10, people put it into their playlist, and then they keep listening to the same playlist. And you know, when you like a song, you know, or a Rolling Stone song or ABBA song, and you have it in your playlist, you just keep listening to it for years, 10 years, 20 years, 30 years. Yeah. Now I have my daughter just turned 18, and she had to listen to my music. Now she likes the music too, right? She's a big fan of Rolling Stones and ABBA and whatnot, although she's so young, but she listened to it, so it even passes on to the next generation. I don't know. I think music is kind of an interesting product. So here, that's what we have in the retail bond, and that's pretty much all I have today. Let me see, time-wise, I'm not bad, right? 46 minutes, exactly at time. So here's my question to you. We can have a short discussion. I have two questions for you. Would you invest 1,000 euro in such a bond that has a portfolio of songs? Gives a nice interest rate, you know, higher than what market has. And what additional information would you need if you were like a wealth manager? If you're now a step higher, not just for yourself, but you're a wealth manager, you want to invest, you know, on behalf of someone 1 million or 10 million. What additional information you need to make that kind of decision, to move out of the classical investment, stocks and bonds, into something like that?
Should we do that? Shall we ask the audience?
Absolutely. So let's open it up. Is there any reaction from you?
Wants to address the question?
Yeah, please go ahead.
Constantine.
Yes, I would buy it, because as you said earlier, if you're passionate about it, a personal investor, if you're passionate about it, and it gives you a better interest rate than usual bonds, then I would do it. Of course, if I was a wealth investor, then you need additional information. It doesn't only cut it if you know the coupon rate and the duration.
Exactly. So that's a good answer. I like it. To summarize, like for small investment, sometimes passion is enough to drive it, right? My personal idea would always be that you should sell it at the moment you have the most emotions, which is in the concert. Like while there's a concert and someone is dancing and singing, there should be a QR code, and you say, this song is great, it's great. I scan it in, they ask you how much you want to invest, 2 euro, 10 euro, 100 euro, you type it in, you buy it. Maybe next day you wouldn't buy it anymore, you're no longer in that kind of state, you know, of happiness. But so passion, yes, passion. Why shouldn't passion be an important factor with investment decisions? And then you probably find out, you know, your heart is sometimes a better guide than your brain, and it could be good. But you're right, on the investor side, it's not enough. You need much more information, and that's what, when they present these kind of bonds to the institutional investor, of course, for hours and hours they're talking about the structure, how they select the songs, the artists, the cash flow distribution, the correlation between songs, stuff like that. And that's what I said, then it's good to, you have some sort of framework already from the financial, you know, theory you can use and apply to music, but it's possible.
Yeah. I have a caveat.
Yeah.
So I'm cynical, right? I'm being
Sure.
I'm cynical, and I'm contrary, okay? Sounds like a good idea. I like this. You're at a concert or somewhere, and you see it, you scan the QR code and stuff and so on. But there's something called financial promotion, right? Because now what we're doing is we're gapping here. We're bridging the gap between something that you're passionate about, and so on, and a financial instrument, because it becomes a financial instrument potentially, right?
Yes.
So the regulator, and that's my question for you, what is the regulator saying about this, right? Because will the regulator be happy that you can scan something? Because now this is open to all kind of abuse, right? It sounds like a great idea, but then people come up with all kind of bonds, perhaps. Yeah. They're fraudulent, perhaps they're not good quality and stuff and so on. What's the regulator saying about that?
Well, I think we are still at the beginning. I mean, we have a lot of regulation. We have, for example, MiCA regulation, regulating blockchain instruments. And what MiCA, the European EU relation, carves out is everything that is in one way or another security, like, or looks like a security, has the same, it's no longer part of MiCA, security law applies. And this is bad because to issue a security that costs like just like 50,000 in fees for the lawyer, right? So you cannot sell a song because you don't pay 50,000. So the moment it becomes a security, problem, right? If it's crowdfunding or some other way you can, you know, hide it, then it's probably possible, but still there's some risk. And that's why we're still at the very early stages of doing this, and that's why the institutional investors are very careful that it's being structured not as a scan at the concert, but rather as a special purpose vehicle who has a certain, you know, contracts and receives cash flow in, cash flow out, because that of course then you can apply security law to it. You know, what are the liabilities? What prospectus do you need to print? You know, stuff like that. But right now we're kind of at the cusp where, you know, still the market is testing the water, and a lot of these kind of things. Wouldn't be surprised when a few years from now lawyers tell you or the judge tells you it's actually not feasible and they have to unwind it and do it something different. But in the long run, if humans want to do something, in the end they're going to do it one way or another. We'll find a way. I'm pretty sure the finance world is creative. They have a lot of lawyers. They find a way to make it happen, and then it should work out in the end. But it's very early stage. This presentation is way ahead of time, so. But still,
we like it.
Yeah, I just want to show you this potentially could be the future. Maybe it's not going to work out.
So you think this is because for the students? The other question, of course, for the students is, apart from this being extremely interesting, is this job opportunity, right? Because we're very concerned about AI, about all this kind of efficiency out there, right?
Yeah.
So you think this would be actually be structured finance 2.0 or 3.0, right? So you know what structured finance is, right? You're like in finance, but you're structuring transactions, okay? Which you and I used to do, right, in the early days, in the 90s and 2000 stuff. So you think this would be become a much larger market for the banks, funds, the ecosystem, and then opportunities? And what would students have to know about? What would they have to learn, apart from the CAP-M that you said, right?
Well, yeah, I mean, learn the old theories because you want to attach it, but also be open-minded in the end, because your criticism is correct. It could be that 5 years from now, music will not be part of any securitization on finance. But the machine will move forward in one direction or another, which means that those 20 or 50 people hired by JP Morgan to do the structuring in music, they're probably not going to be fired. 5 years from now, they say, well, now art is a big thing. You know, you did music, can you do the Picasso? So then, you know, if you're flexible enough and say, well, I'm not attached to Taylor Swift, I can also do Picasso, then it's the financing of Picasso, or maybe it's a racehorse, or maybe it's real estate in the metaverse. So we don't know the future. All you can do is prepare yourself, be open-minded enough to do something creative in one space, then I'm pretty sure you will be able to switch into another creative space. And some of these things will be successful. I'm pretty sure. We already saw it with Bitcoin and these kind of cryptocurrencies, very successful in certain areas. And this is just a new thing. And if not that, then something else. But you have to start somewhere. Because if you just keep waiting, and I want to wait until this happens, and the Supreme Court has, you know, signed off on it, and there's enough volume going through, and the last bank is doing it, and the last investor doing it. If you wait that long, it's too late. All the jobs are already taken, so you have to start early, open your mind, and
so we should look out for the job adverts for structured finance in tokenization. But I think it's an interesting icebreaker in a job interview, right? That you said, I went to the lecture by Professor Tata.
Well, that I don't know.
No, seriously, I think it's an interesting one, right? Any other questions that you have? You're happy?
Yeah.
Yeah.
We're especially seeing in the music industry right now that like only some populars get hyped through Instagram Reels or TikTok. So how does this affect this kind of idea or blockchain music bond? Because you're like sometimes focusing on a very short time on a certain song and then it will be gone. How does it affect it?
Well, because they use catalogs. They move away from the idea of one artist and one song.
Exactly.
And they say, you know, there's always certain demand for a certain type of music, right? It's always going to be. And nowadays, people need to pay. Right? You cannot like download for free, or if you're at the bar, you turn on the TV, you have to pay an extra rate because of the streaming rights and stuff like that. So the money is flowing already. The lawyers made sure that everyone needs to pay for it. So the money is coming in, and that makes it a rather conservative market. As there's money in the pot, you can do something with the money. It's not necessary, but that's an interesting thing. I find that there's a different perspective. From an investor, it might be highly emotional that you say, I really like this artist, this kind of music. And from investor perspective, it's, you know, I'm agnostic about it, right? A good investor is kind of agnostic. A good investor buys the S&P 500 index. Why? Because it's a highly diversified index. That's the end of the story, I buy it. And wouldn't go into the 500 individual stocks and say, oh, this stock, they are selling dog food, I'm not sure about it. That's the wrong perspective. The investor, you know, has like open-minded, I don't care where the money is coming from. Maybe certain things exclude, no drugs, no weapons, no this kind of stuff. But then in the end, every activity is part of the portfolio. And the same with the music, right? People listen to music, it's in our heart. We're doing this since, you know, we separate ourselves from the monkey, we're singing and dancing. So music's going to stay with us one way or another. What kind of music? Sure, it's going to change. What kind of art is going to change? But if you have like a diversified music catalog, you don't care, right? In the end, it's very unlikely that one year people, you know, say, oh, we're not going to listen to music anymore. Music is out. No, close my eyes, ears, no music. Very unlikely, very unlikely. So, you know, that way I'm pretty optimistic that something will be developed. I don't know when, I don't know what the size is it, but it gives you an opportunity to kind of look for something cool and new. And the good thing is always, you know, again, I'm always giving here my other presentation about, you know, career advice, is you're competing with the old farts out there, right? And the old farts, they know so much more about the old products. There's no way you're going to catch up and be smarter about the convexity adjustment on the 30-year IBM bond. Nah, but where you beat those old farts is this kind of new technology and product. So when there's a job interview, guess whom they hire? They hire you, although you have very little job experience at that juncture. But this is an opportunity. Change is good for you. You want to change in the market. And jump on the new stuff, not on the old stuff.
I think that's interesting. Really, I think it's a very good finish. That, you know, the advantage that young people have over older people. I'm not going to apply for the job, so I have bad news for you. You probably neither, but they also need some more experienced people. But I think we'd like to give you a round of applause.
Thank you for your time.
Thank you so much. It was amazing. I think you give another lecture tomorrow, and today is very well in demand at the university. If you want to come, we're going to talk about career tomorrow morning.